Hello, everybody, and welcome to the Canis Major Incubator video deal blog. Each week we present a case study, lesson learned, or something about investing in Texas commercial multifamily real estate. And this week we have a very special case study. It's being presented by Sanjay Aggarwal, who's one of our Canis Major Incubator Acquisition Specialists. And Sanjay, are you on the line?
I am.
Can you take us through your Canis Major case study?
Of course. Thank you, Phil. Hello, everybody. So I'm very excited to share this case study. You may be wondering, why are we sharing about the single family in a commercial multifamily deal? Let me just address that up front. One of the reasons is this portfolio of single-family houses, we treat it just like a commercial deal as you would in a multifamily or any other commercial deal. We take a group of houses and treat it, buy it as a block of houses, manage it together, and when the time comes, sell it as a block, just as if you would do on a multifamily deal. It very much works similar to the multifamily commercial deals, but there are small differences, being these are single family and spread out, that I'll talk a little bit as we go through the deal. So let's walk through this. Just a quick background on myself. I'm a mechanical engineer, worked in the industry for 16 years, and did the business school, and a lot of the engineers follow, but started in the real estate as a kind of a hobby and a way to not waste money on rent early on, where I bought my first house at 24 and sold it a year and a half later when I moved for the company for a $23,000 profit and put that into the next property. So it started there, but from there on, I worked in the corporate world and started to look more into the real estate, where I got my realtor license in Texas, and have been rehabbing houses since 2015. I started working with Phil and Shanoa and had the opportunity to join them in 2016 and joined Canis Major in 2017. Again, I'd like to thank Phil and Shanoa here. They've been great. Their network and everything they have put together has been awesome. Some of the deals that I've been part of, you can kind of look here outside of Houston and Henderson and 152 complex, Elam townhomes, that actually we'll talk a little bit about here in East Dallas area. We flipped 40 single-family homes in 2016 and bought a portfolio of houses in Houston, 15 houses, and the syndication that we did with these 20 single-family homes. With that, just a few quick pictures of some of the houses from the 20 single-family homes. Very typical homes, very high in demand. All of them are located within 5-mile radius in East Dallas and Mesquite area, right off of the 635 highway, most of them. We were able to buy a great deal at 70% minus the repair with the rents below market. The seller had owned them for a while and hadn't kept up with the rents and the repairs and was looking to get rid of the headache, and we were very happy to grab this deal and take it. Before we get into the details of the deal, I'd like to touch base on a little bit on how to find the deal and do the due diligence. So this specific deal came through the network and the previous relationships. In this world, whenever we talk to somebody, they remember, and that's where the deal came from, where somebody thought of us and they called us, and we jumped on the deal immediately, very quickly. In terms of due diligence, driving by the neighborhood, looking at the outside condition of the house, roof, foundation, landscaping, cleanliness, all the factors, immediately the same day, as soon as you find out is that's what we did here, and that is required in most of these deals, as good deals are the ones that go fast, so have to react fast. In parallel, the online research with comparables, CMAs, demographic review, macroeconomics of the area, which in this case, we actually knew this area very well from the flips that we had done in 2016. Once we have that, we have a contract, we negotiate, which we talk on the next slide. We inspect each and every house, look at the rent roll, lease reviews, review the insurance, utilities, tax rates, and start to talk to the lenders. A lot of the times, lenders are the key to these deals. So have to engage them initially upfront to make sure we have a viable option and something workable there. In terms of the contract negotiation, while the due diligence is happening, it's very important to talk to the seller and give them a strong confidence that we're a strong buyer and we will close once we are under contract. For these portfolio of houses and on the multifamily side, that's very important for the seller because they're disturbing the tenants with inspections and visiting and appraisals, and if it falls through, they have to go through the process again, and they may start losing the tenants if the tenants know that the owner is looking to sell and various other factors that go in. So presenting yourself as a strong buyer, proof of funds, maybe talking about previous examples is very important, and giving that confidence helps tremendously to actually get the deal under contract. As part of that, you can also explain, and that's what I did here, is how we make the transaction easier for the seller by sometimes you're able to do with just one visit to the house during the inspection or appraisal and don't disturb the tenants multiple times. Demonstrate the financial strength, proof of funds, contact with the lenders, or some sort of a statement or a letter from the lender confirming your net worth or your capability to do the purchase. Then the negotiation starts on the initial price once you have kind of presented yourself as a strong buyer and given some confidence to the seller. Once the initial asking price is negotiated.
Sanjay, I'm going to interrupt you for just a second. I apologize. I was just going to say one of the kind of competitive advantages we have at Canis Major is the fact that we're a network. The combined net worth of the members of this group is, hundreds of millions of dollars when you combine all the deals and experience and, network, financial resources, et cetera. And being part of a network is certainly something that gives the sellers a lot of confidence that you've got the resources to actually be able to close your past experience closing deals, et cetera. So that's something that we feel is kind of a competitive advantage. And didn't mean to interrupt you, but I just wanted to throw that in there.
No, that's a good point, and that's exactly right. Depending on the different areas where the deals may be, you always, in the network, there's always somebody who is in an area to do help with the due diligence, as well as the financing, the proof of funds, the lender contacts, and you can present that provide confidence to the seller, and that definitely helps and has helped on these deals. So anyway, very good point, Phil. Of course, from a negotiation perspective, you can negotiate other costs and terms, title, survey, commissions, timelines, and again, once the inspection comes back, if the repairs are high, there's an opportunity to negotiate again and maybe strike a better deal, make a good deal even better. So let's talk a little bit about this 20 single-family home operations. Within the first 6 months, we were able to increase the rents from initial $14,000 to $18,000. We started scheduling the repairs and deferred maintenance immediately. which kind of goes into increase in rent. We send out the notice to increase the rents within the 2 to 4 weeks of takeover. Some tenants moved out, some tenants negotiated repairs, flooring upgrades, garage conversions, etc., to agree to a higher rent. And that's a key. The higher rent is a key. On this particular project, we completed about 200 foundation piers, 10 roofs, 4 garage conversions, 3 full rehabs, and approximately 12,000 square foot of flooring, in addition to other things that were needed to be able to achieve the rent increase. So let's look at this deal, some numbers on this deal. In the phase 1, when we purchased this, our purchase price was $1.4 million, approximately $70,000 per door. We estimated a rehab of about $200,000. Initial capital raise was $650,000. That included down payment, closing costs, syndication costs, other reserves and expenses. The loan that we took out initially was $1.3 million, which included some of the rehab. At the time, beginning, we projected to value around $2.4 million at the end of 4 or 5 years. And as we have evolved and where we are at, just about to complete 1 year of the project, the houses were appraised at $2.1 million for the 19 of the houses. We had to take one house separate because of the new lender requirements. New loan was 65% of the new appraised value, so 1.365. We got some better terms than the previous loan, so 30-year amortization, 5-year fixed, and a 5.75 interest. That left an equity of about $735,000 in the syndication, which is already higher than the original cash investment of $650,000. So from this, we took one step further where we added additional income without any further raise or adding any more money. The way we did that is we took 8 duplexes, total of 16 doors, for $800,000. Took out a loan on that for 80%. Since this was a purchase, this loan was slightly different. Total loan of $690,000, which included the 8 duplexes and that one house from the 19 houses. So this is a second loan that we took out for the additional duplexes. Seller gave a repair credit for $47,000 towards the duplexes. Total cash that was needed for purchase was $117,000, including some of the costs and stuff. We were able to fund that from the $150,000 as well as some of the financing that we got from the original 20 houses. So we were able to fund that without going back to the investors for any additional funds, and added approximately $10,000 in gross rent to the syndication. So how does it all look combined together as we stand today? The stabilized value of the portfolio today stands at $3 million, $2.1 million of the 19 houses, and $900,000 for the duplex plus the one house from the 20 houses. Total loan amount, the two loans combined, is about little over $2 million. That leaves an equity in the syndication of $1 million. So now we have 36 door with gross monthly rent of about $29,000, with a approximate NOI of $15,000 per month, which gives a cash flow of 12 to 15, the cash and cash return of 12 to 14%, which is an increase of our original that we projected at 8 to 10%. So that's all the material that I had prepared. Phil, you have any questions or anything else you'd like me to add on this deal?
Well, obviously, it's a great story, and your original investors that looks like put 650,000 in are getting a nice double-digit return on their investment, and they've already made $1 million in equity. Any other lessons learned on this story?
Yeah. So one of the biggest lesson is the lender and the financing. With the original purchase, as we got into the financing, we made it happen, but there were some challenges that we had to come across. But the bigger one was when we went to refi with a new lender. While their terms were very attractive, their criteria was very narrow, which is why one of the house wasn't included, and the 8 duplexes that we all wanted to roll into one loan, they weren't really that receptive for that loan. But this is the biggest lesson learned is you don't give up with the lenders. While they may be difficult, while they may require a lot of documents, you just have to stay on it, be patient, and keep going and keep your creative hats on. And there's always a way. There's always something out there that you can finance and make it happen. It's a lot of hard work for that lender and financing to make it work. But once you make it happen, you make $1 million.
Well, there you go. Well, that's a pretty awesome case study, and thank you so much, Sanjay, for going through all that today. And for all of you that are listening, each week on Canis Major, we review a different deal, case study, lesson learned, or technique to invest in commercial multifamily investing. So stay tuned for next week's video as well. I'm Phil Grove, and thank you all.